Hi, good evening, all. First and foremost, let me all welcome you for joining this webinar under short notice. And however, of the reasons that made us organize this forum is to bring more clarity into one of the widely spoken and broadly misunderstood topics, which is the domestic debt optimization. On that front, we had numerous discussions, numerous forums, speculations, and opinions on the topic, where everyone did have a skeptical uh, addition to it, their version of uh, point of view on it. And I think today it's important for us as an investment bank, we shoulder the responsibilities of bringing to our clientele more clarity on the matter. And with me is the head of research of First Capital, is Dimantha Matthew, who has over 2 decades of exposure and experience in research. And the main objective of this discussion is to fully understand what domestic debt restructure is and its influence on the financial system and how it scales to a broader economy. Dimantha, I would like to set the tone of the discussion by asking you to broadly explain what a domestic debt restructure is, what mechanisms the government would initiate in order to derive its full uh, benefit, and what are the merits and demerits of a domestic debt optimization, as popularly termed, in the short and long run. Over to you, Dimantha.
Thank you, Angelo. First and foremost, I think I need to apologize for some of the investors who are looking at joining us. We didn't expect such a significant demand here, but we have a maximum of 100 participants for this event. So I think some are unable to come in because of that. So let me first explain to everyone what we are looking at doing here. So there was a lot of discussion on debt restructuring, and what is debt restructuring was also a huge topic. So as as it was explained by the governor over many times, so what we are trying to do here is to basically it's something similar to where individuals take loans, and what happens is when you come to a stage that you can't pay your loans, then for banks it goes in as bad debt, and then there are negotiations that take place to basically change the terms of the loan, and or to try and bring it into a area where you can sort of pay again and go on. So for a country also, it's similar. Here, what the government is trying to do, or with IMF is trying to do, is to look at bringing in a reprofiling or restructuring the loans that the government has, and trying to come into a level where the loans can be paid on an annual basis. Yeah. So in that situation, we have two arms here. One is basically foreign debt restructuring, and the other is domestic debt restructuring. So I'm explaining this before we come to the presentation, so that everybody is on the same page, right? Now, in these two types of restructuring, now what the country has gone through is this economic crisis mainly came about because we ran out of dollars. So Sri Lanka ran out of dollars, and then so the problem that we have is the lack of dollars, and we are unable to pay foreign loans. However, we continue to service the domestic loans. But the situation is overall the total debt of Sri Lanka has gone above 100% of the GDP. And as at end of last year, including the state-owned enterprises, it's recorded at 128.1. So in such a situation, we have done a sustainability analysis, and the IMF has determined that our level of debt is unsustainable. So in such a situation, they have decided that some amount of debt has to be brought down on an annual basis, and possibly basically there are multiple ways of doing that. So how do you do it? One way is to bring down your capital, that is the repayment capital. The principal amount is reduced. That is called a principal haircut. Then you have the coupon cuts. That's the biannually there are repayments going on in terms of bonds. Those coupons can get cut, right? Then the third way of doing this is by extending the maturity. Right? So then finally you can do a hybrid of those instruments. So I will roughly show you a presentation that we have done earlier before coming to the debt restructuring. So this is where we were at the start of the year. And this is 83 billion dollars was the debt that we have to pay. Out of that, 38 billion is local, 38 billion is foreign. Then excluding multilaterals, all other debt we were in areas. So out of that, as you can see, 46% is external debt. Okay. And out of that 46%, you can see multilateral debt is 27%, commercial debt is 42%. That's where the ISBs come in, right? Then bilateral debt is 31%. Out of that, then you have the bilateral debt, out of which 43% is the Chinese loans. Right. So with that, I will now show you what the government is going to do. Right. So once again, these are the options that are available: principal haircut, coupon cut. Then you have the increase in maturity or hybrid of the above instruments. So you have 4 areas that you can do. Okay. Now we will go into the presentation. So what has happened now is that Sri Lanka is going to go into the negotiations of debt restructuring. As I told you, you have the local, you have foreign. Foreign debt negotiations have already started now. Now, this is this presentation is primarily related to local debt restructuring, right? As I showed you, almost 50% is local debt. So we'll need to bring down both elements to achieve the sustainability level of debt. So I would like to request everyone if they can to mute their mics so that we can go forward. Yeah. So these are the 4 areas that we are looking at touching: debt sustainability analysis targets, why domestic debt optimization is essential. Then we go into the terms and then the timeline. Right. So these are the targets that the IMF has set us to achieve over a period of time. So public debt to GDP needs to come below 95% as of 2032. So debt to GDP ratio needs to come below 95%. Currently, it's at 128%, including the state-owned enterprises, which some might actually get privatized. Okay. The second problem is the biggest problem that we have, the gross financing needs. So what is gross financing needs? The amount of financing or loans that the government needs to raise on an annual basis. Right? So every year, the amount of debt that the government needs to raise. Now, this amount needs to be below 13% of GDP. Now, currently, it's above 30% also above GDP. So that's why we need to restructure debt. Then finally, the foreign debt component. So out of this 13% of GDP, we are only, or the IMF only allocates the 4.5% of GDP needs to be foreign debt servicing. So basically, you have 13.5, only 4.5 can be foreign debt servicing. Balance, we have to raise money locally. That is 8.5% of GDP needs to be raised locally. Right? Then finally, overall, the external financing gap. What is this? The external financing gap is the annual amount that the government has as a gap in the budget. Right? Now, during the period of the IMF has told that their funds can be, part of their funds can be used for budget financing. So to bridge the budget deficit. In addition to that, funds have been arranged from ADB and the World Bank in order to bridge this financing gap. So the balance funds we need to raise locally and from overseas sources. So over the next 4 years, as we go into this foreign debt restructuring, we won't be able to raise funds overseas, right? As soon as we restructure this debt, until we start to repay debt again, or until at least the grace period goes off, we won't be able to raise debt. Now, the IMF estimates this year to be 2027. So they have identified that we can go back into the foreign debt market and raise debt by 2027. So until that, the balance amount of funds we will have to finance locally, right? So that gap that comes out of the funds that we plan on raising from overseas, the IMF is looking at bridging through IMF funds, ADB, and the World Bank. Okay. And for the 4 years, the amount is identified as 16.9 billion. Okay. Right. So let's look at why domestic debt optimization is required. Now, the IMF started off with something called the debt sustainability analysis. So they've recruited a foreign firm to do this sustainability analysis and identify what needs to be done in order to bring debt to a sustainable level in terms of Sri Lanka. So they've looked at multiple ways of handling this. And so what happens if you don't treat debt? So if you don't treat debt, our GFN on average goes to around 16.8% of GDP. So some years it's 30%, some years it's less. But on average, between 2027 and 2032, it is at 16.8%. So by that, if we do nothing, that is, we won't meet the gross financing needs target, right? If we do some adjustments and even if we reach the debt to GDP targets, we won't reach the gross financing needs target. Okay. Then, what if we only do an external debt restructuring? Right? So there are now when you're negotiating with external creditors, what do you have to consider? Now there are multiple things that comes in. Now we are not the first country that is getting debt restructured, right? Now what happens because of that? You have precedents as to how it has been done, right? So in such a situation, what the government is targeting is to look at a certain level of debt restructuring in the foreign side. So at the moment, they are looking at a 30% principal haircut on the ISBs. And then also a maturity extension. Right? However, bilaterals don't seem to be agreeing to that. Right? Then you have a different mechanisms for bilaterals. So in countries such as Zambia, who recently concluded their external debt restructuring, so the bilaterals didn't agree for a principal haircut, only a very long-term maturity extension and a grace period. So in that case, we will also have to go for something like that. Because why is that? Because some of these or most of these bilateral debt comes with lower coupon rates, right? So because of that, but if you take ISBs, some ISBs come at 6%, 7%. So those high rates. But then external debt comes at much lower rates. So because of that, we won't be able to negotiate the same way we negotiate with ISB bondholders, right? So if we do only external debt restructuring, IMF has forecasted that our gross financing needs, according to this debt sustainability analysis, will be 14.2% between the period of 2027 and 2032, right? So because of that, we require external debt restructuring and domestic debt restructuring. As you can see in the final box, if we do external debt restructuring and domestic debt restructuring both together, then we can bring down by 2027 the average gross financing needs between that period to 12.7%. So as you can see, the DDO is aimed at impacting the gross financing needs by 1.5%. That is 150 basis points. So let's now look at what are the terms that are being proposed by the central bank. So let's first look at central bank treasury bills and the advances that central bank has given to the government, right? Now, the proposal that they have put forward is to convert these treasury bills into treasury bonds, right? And it comes in two forms, right? They are proposing it to be converted to 10 different instruments. That is 10 types of bonds. Out of the 10 types of bonds, 4 bonds to have maturity periods between 2029 and 2032. So you'll have a bond in 2029 maturing, 2030 maturing, 2031 maturing, and 2032 maturing. So you will have 4 instruments maturing in those 4 years. Right? Then balance 6 instruments are looking at being matured between the periods of 2033 to 2038. So there'll be 1 bond in 33, 34, 35, 36, 37, and 38. Right? So with that, so there'll be a bullet repayment at the end of the principal amount. So this is going to be in the second phase. So that means there's going to be 2 phases in terms of the domestic debt optimization, and this will be implemented in the second phase. So what is going to be the interest rate? Okay. So there are multiple ways of providing the coupon. You have, we've seen step-up coupons being proposed and fixed term coupons being proposed, and this is a step down coupon being proposed. What is a step down coupon? That is, for a short period you're going to get 12.4% interest. So 2024 and including 2024, up to that you will get 12.4% of coupons. So most probably the central bank will get 12.4% of coupon because they are holding the bond, provided they don't sell it down to the public, right? Then from that point beyond 2024 up to 2026, that is the next 2 years, 2025 and 2026, the coupon will be limited to 7.5%. And then finally, until maturity, the coupon will be 5%. Right? Then we will go into superannuation funds. So treasury bonds owned by superannuation funds. So this is not only EPF, ETF. There are other private pension funds in the market. Obviously, smaller than the EPF, ETF. EPF, ETF will be the largest. But all these funds have treasury bonds. And these will be, anyway, they look at only long-term bonds. So currently what they have will be also long-term bonds. And they will be exchanged to longer-term maturity bonds. And 12 types of instruments are being looked at. So probably one type coming in for each year from 2027 to 2038, right? So for these funds, they are not proposing any principal haircut, and it's proposed a bullet payment repayment is proposed at the end, and then a step down coupon. So first couple of years, or first 3 years for that matter, the interest rate will be 12%. Then until maturity, it will be 9%. So this is applicable for all bonds. Right. So here, they're looking at banking sector. What is going to happen to banking sector treasury bills and treasury bonds? So if you remember, banking sector is basically post economic crisis, and from 2019 you can see how much banks have supported the economy by multiple amount of debt moratoriums. So one thing because of that, and the other thing because the tax burden for the banks is at a very high level. They are paying corporate tax of 30%. Then there is financial VAT of 18% being paid. So all this, because of that, you will have a significant amount of tax that is charged on the bank. So it's about directly 48%. If you take the effective tax rate, it comes to around 55%. Right? So because of that, they will not be subject to bonds. They will not be subject to the rupee bonds. The rupee bills and the rupee bonds will not be subject to any type of restructuring. Okay? Also, another reason why they are not doing that is non-performing bonds. However, the ISB bondholders, the commercial banks hold government security, the international sovereign bonds, right? They will be subject to debt restructuring. So basically, there is a bondholders committee that is formed for foreign debt restructuring, that is the ISBs, and the banking sector will be part of that. And whatever the debt restructuring that comes into ISBs, they will have to suffer that amount of debt restructuring. At the moment, what is being proposed is about 30% principal haircut and a maturity extension of around 6 years, right? Then they have SLDBs, right? I will straight away go into how the SLDBs are going to get treated, right? So what happens here is that they are given 3 options. So one option is that they can get their SLDBs transferred into another dollar bond or dollar instrument, which has a 30% haircut. So if the principal amount is $100, you will at the end of the period only get $70. Okay. So that type of instrument will be given with a 6-year maturity extension, right? So 2029 is the extended period. And of course, now what's left is 1 year of the all SLDBs are expiring within the next 1 year, right? We have $800 million of SLDBs, 95% owned by banks. Yeah, so and a fixed rate of 4%. So the second option is you can have no principal haircut, but a 15-year maturity extension, right? So a 15-year bond is replaced by the current SLDB that you have. The current development bond is replaced by a 2038 maturity bond, which has a 9-year grace period, which means you get nothing for 9 years, right? And then a fixed interest rate of 1.5%. Okay. So the maturity, so the first from 2033 onwards, you will get. The other option is to convert it into a rupee bond. That's very simple. You get a 10-year bond with a floating interest rate, right? Which is the SLFR plus 1%. Right. Then we'll look at the timeline, right? So on 28th June, that is yesterday, Cabinet has now approved the domestic debt restructuring, right? Then today, there will be the first session that is with the government of Sri Lanka, the central bank, and the committee of public finance, officials of them, will look at the feasibility of this proposal. Then, of course, there will be a session 2, possibly the afternoon session, where they will give their feedback on the strategy of that, right? And that will be given to all the banks, insurance, and the superannuation funds, right? So the feasibility will be discussed with the officials in session 1, and in session 2, feedback is given. Okay. And then finally, you have on the 30th, you have discussions taking place with all the stakeholders that is relevant for this DDO, right? Yeah. So all the parties involved, again, it will be the banks, insurance, and the superannuation funds, of course, because ISBs are also involved. And so all those people will be discussed with, right? And then finally it will be submitted for the approval of the Committee of Public Finance. And finally, on the 1st and 2nd, it will be submitted to Parliament for debate and voting. If it passes in Parliament, so it will be approved. And then they will look at implementing it. Right. So that comes to the end of our presentation. Yeah. That's about it. I would like to hand over proceedings to Angelo.
Thank you, Dimanta, for that very elaborative and timely explanation. I think we have a list of questions and we have about 15 minutes to go. So I'll directly jump into the questions, Dimanta.
All right.
And for all who are in the forum, please drop in your email address as well with your question. We will be writing to you all. In case we don't get to answer, we will be writing to you all via email. So, Dimanta, first question. Is the DDO, this is from Mr. Patiraja, is the DDO going to impact retail and individual holdings?
Yes. So, very direct question. I think it is not going to impact any individuals or corporates. So there will be no restructuring of any of the treasury bills or treasury bonds owned by individuals or corporates as per the proposal currently that has been submitted.
Okay. I believe the question was answered. I'll go to the next question by Mr. Vishwalingam Muralitas. Please explain the impact of DDR on treasury bill. I think you captured this where you had mentioned. Do you like to elaborate on this?
Yes. What was the question again?
Question again. Please explain the impact of DDR on treasury bills.
Right. Okay. So in terms of treasury bills, now a lot of people get this confused when you say CBSL holdings treasury bills, because most people think that your treasury bill also is issued by central bank. So is it subject to? No. The answer is clearly no. If an individual or a corporate is owning treasury bills, you will not be subject to treasury bills. There are separate treasury bills that the central bank is currently owning, and the central bank gets interest out of it, right? Now we could say indirectly it is sort of like printed money, you could say. In the open market operations, you will see that there is a treasury bills owned by CBSL section, right? You currently have about 2.6 trillion rupees owned by the central bank. That is the segment. Whatever the central bank is owning is getting subjected to debt restructuring. If you're owning under your name those treasury bills, that is not going to get restructured.
Very clear, Dimanta. Thank you. Another question from Sucharita. What will happen to T-bills placed through First Capital?
Yeah, so a very clear answer. Since it's individuals and corporates mostly owning that, it will not get subject to DDO. Either what First Capital is owning or what its customers are owning are not being subject to debt restructuring.
Okay.
Right.
Thank you. I'll jump on to the next question. Ruanthi De Silva. How will all this restructuring affect the average bank customers who have fixed deposits? Can you advise on both rupee deposits and dollar deposits?
Yeah, so very simple, since banks are not subject to DDO, one thing, the bank is not affected. And then deposits. The governor has clearly told that the deposits are not going to get impacted because of a DDO. So impact is 0 to be exact.
Thank you. Once again, Mr. Vishwalingam, could you explain the coupon rate and charges based on DDR? I think it's a broad question. I believe you addressed this during the presentation. Would you like to touch upon it briefly? I'll repeat the question again. Could you explain the coupon rate and charges based on the DDR?
Coupon rates and the charges. Does it say whether it's SLDBs or treasury?
Not specific. Not specific.
Okay, okay. I will answer
specific.
that question in general. So,
right.
Whatever the treasury bills and bonds that are currently in the market, so the DDO is only subject to specific investors, right? I'll put it in that way. That is two types of investors. One is central bank themselves. They are also an investor, right? Because they are holding some amount of treasury bills and treasury bonds, right? The other is the superannuation funds like the EPF, ETF, and also you have some private pension funds, right? So these two types of investors are the ones that are impacted, and they have their bonds being exchanged to other different types of bonds, which has a step down coupon approach. The rest of the investors are really unaffected. So whatever the coupon you're currently getting will not change.
Clear. Let me go to the sixth question, Devanta. Jagat Nishankar, please explain impact of DDO on the Colombo Stock Exchange with sector-wise impact, specifically on the banking sector and financial institutions.
Yeah. So in terms of banking and financial institutions, we all know that banks own ISBs, that is international sovereign bonds, and Sri Lanka development bonds. So international sovereign bonds, there is a high likelihood that there could be a 30% haircut. That's the indication that we received, right? It's not finalized as yet because the negotiations are going on, right? So what we've seen is that most of the banks have already provided 30 to 40% in terms of provisioning, right? So because of that, there will not be an impact going forward, right? However, we have the SLDBs. Now, SLDBs being restructured is something new to us. That was something that we did not really expect. However, a few of the banks have actually done some provisioning in this aspect as well. However, there is no real requirement, because even if you take SLDBs, the banks have three specific options. One is to go into a dollar bond itself. If you're going for a shorter maturity, as I explained earlier, you will be subject to a 30% principal haircut. However, if you choose to go for the longer tenor maturity, that is the 15-year bond, then you will have no principal haircut, but there will be a grace period, right? But the best option that most banks are even currently adopting is to convert it into rupee bonds, right? So for rupee bonds, what they are offering is a plain vanilla 10-year bond. However, it's a floating interest rate that is being offered. I guess that
Right.
answers the question. Yes.
Yes. Let me go on to the next question. CBSL has calculated the gross financing needs based on the future ambitious revenue targets. So going forward, we don't achieve the fiscal targets. Shall we expect another restructure? I think it's a very important question. We had this question come up a few times. I would like you to elaborate on that as well.
Correct. So it is extremely important now. Our debt to our government revenue to GDP as at end of last year is 8.2%, right? We should be somewhere around 13-14%, right? We don't expect it to increase this year either because of the contraction of the economy. But revenue, of course, overall is likely to slightly improve, right? Then obviously we have some stopped some of our projects, so the budget deficit will improve. Now this year already we've gone into a primary surplus, right? Which is what is expected by the IMF. Now that primary surplus is what's important to achieve the debt to GDP target and the gross financing needs target, because part of the debt payment is supported by the revenue. That means having a primary surplus means that your that surplus goes into debt repayment, right? So we've already gone into primary surplus. Obviously, we are not paying some of the foreign debt, but from next year onwards, I think we'll start paying. But important thing to know is that we will be relaxing our trade. We are a net importer, remember. We'll be our trade restrictions will be relaxed this year, and next year we are looking at a positive GDP growth, right? And so in two ways you will have revenue increase. One way because GDP itself grows, and the other is that because of imports now starting to come in, from that on that side also you will start getting revenue. So we believe that by around 2025 we will be close to 9% and then move on to 10%, 11% of GDP as the economy recovers and SMEs start recovering in business. So I think going into another crisis will depend on the main factors of reform. Whether we will do the state-owned enterprise reform, because no matter whatever you do, if the CPC or CEB or Sri Lankan Airlines start making losses, now these are massive losses that they can put in, right? So if those losses start coming, then we have a big problem again. But as long as we go on this reform agenda, I don't think we'll have an issue in the shorter term.
So essentially what you are saying is the SOE's restructuring would be pivotal in terms of identifying or trying to gauge whether another restructure would take place.
Correct.
Right. Okay, let's go to the ninth question. I think this is more an opinion than a question. what shares will benefit from the DDO process?
What shares will benefit?
I believe primary dealers and banks will benefit for sure.
Yes. So having no, so what's let's see what happens in this situation. Now, here, now there is no DDO except for superannuation funds and the CBSL holdings, right? So, which means the overall yield curve needs to drastically decline.
True.
Basically, it needs to normalize. Currently, the yield curve is inverted. The shorter tenors are trading higher and the longer tenors are trading lower, and it's trading above 18%. Everything, right? So the whole yield curve needs to drastically come down and normalize, right? Now, who benefits out of that? Obviously, the primary dealers, basically the treasury counters, will benefit out of that, right? In addition to that, you can see the banks. Now, the banks are currently trading at, Angelo, 0.3 times earnings, right? Now, why are they trading like that? Similar to bonds trading at a premium, these banks are trading at a heavy discount because of a expected hit from the domestic debt restructuring, which may lead to rights issues and other equity raising, right? As the economy recovers and NPL ratios fall, the banks are likely to improve in terms of earnings, and ROEs of banks will significantly improve. However, mind you, there is a bit of a risk. Remember, it depends on how much of a delay is taken for the economy to recover, right? I think the central bank is adopting an accelerated path of reduction in policy rates to revive the economy. Now, banking sector performance also is based on that. Now, they've already given a 250 basis point rate cut in June. Now, we expect as First Capital another 250 basis point rate cut during the July 6th policy meeting, right? Which will significantly bring down rates and revive the business sentiment, the SMEs, the loans, the credit, private sector credit, which is very important, is likely to revive, right? So, and in that, all businesses are likely to benefit out of that over a period of 18 months. But if you ask me, what is the immediate beneficiaries? Yes, the treasury counters, the banking counters are the immediate beneficiaries. However, take the food, beverage, and tobacco counters will significantly benefit with the revival of purchasing power. Now, as interest rates come down, as finance costs come down, high debt companies, companies that are importing are likely to significantly benefit as time goes on. So,
Dimanta, I've been told
in short, Angelo, all the companies over 18-month period of time will significantly benefit during different intervals.
All right. Dimanta, I've been told that we have only about 1 minute to end the session. So for all who sent their questions and unanswered questions, please do drop in your email address. We will write to you all within the next 24 hours. And would like to invite you all to join us on the live streaming. I think most of you are on our research broadcast through WhatsApp. We have shared a link. Please register yourself. We will also share the link to whoever is on, who mentioned their email addresses on the chat box. And Dimanta, on this note, I would like to end proceedings as we are running short of time. I want to thank you.
I would like to mention one more thing just a reminder on our forum that we are having, the Colombo Investor Symposium happening on the 4th of July. You can register yourselves. We've shared a link on Facebook. We've sent it via WhatsApp as well. So anyone interested can register that. And we will be discussing these aspects in much more detail. In addition to myself, there'll be Nishan Dimel, eminent economist coming from Verite Research, then the head of the state-owned enterprise committee, Suresh Shah, will be there, who is taking us through the reform program. So that's just a brief of what's yet to come. Yes, over to you, Angelo.
Right, just would like to conclude proceedings. Thank you all for joining under short notice, but the discussion was very timely. And I think we did our due diligence in delivering you something which is elaborative and probably broadly spoken across different platforms. Thank you all.
Thank you.